Welcome to the Real News Network. I'm Paul Jay in Washington. Well, we've all noticed the price of coffee has gone way up, and you might think it's because there's a lot more people drinking coffee or a lot less coffee beans in the world. Well, if that's what you think, you don't know the whole story. Now joining us to talk about the price of coffee and speculation is Kevin Hall. He's the national economics correspondent for McClatchy Newspapers. Thanks for joining us, Kevin.
Thanks for having me, Paul.
So what has your investigation found about the price of coffee?
Well, we found that there are a lot of similarities to what happened in the oil market. The perception of supply tightness, in fact, record supplies of coffee, and around this perception, suddenly a flood of new money into the futures market, or the market for contracts of delivery, future delivery of coffee, and that has influenced greatly both the physical price and what big marketers of coffee in the United States and elsewhere can charge for coffee.
So what examples have you found, or what's the research?
Well, what we found is that from a period of about 2000 forward, it corresponded with commodities across the range. You had a lot of this financial money, whether it's institutional investors like pension funds, a lot of big hedge funds, beginning to pour into this market after the reforms of 2000 that allowed easier access into these commodity markets. You had a huge influx of this speculative money, and this money now is a dominant force in these markets as end users who buy coffee because they need coffee as part of their product, whether it's a food company that makes ice cream out of coffee or big things of that sort. So I think what you had is a similar phenomenon to coffee, where you have a crowding out in these markets by financial players of the people, crowding out the people who used to dominate these markets.
So if you're an actual coffee producer, I should say like a grinder, coffee distributor, and you're buying coffee in the market and you want to lock in next year's prices, you're locking in at a price that's been driven up by someone that already went long on the price.
Right, and I think where you had a settlement process before, now that's been pushed out, and it's actually one of the things I've found in the reporting is that even on the farm level, a lot of specialty coffee, organic coffee, environmentally friendly coffee is done through these cooperatives. And the cooperatives are now having problems because the middlemen who buy coffee are offering higher prices than what the cooperative had locked in for its delivery price. And some of the farmers, the campesinos in Latin America, are walking away from the cooperatives for higher prices. And coffee has a long history of boom and bust cycles. And it's pretty easy to foresee when you have such a massive amount of planning tied to this price that you can foresee a bust cycle coming, and these farmers will no longer have the shelter of a cooperative as they lose that part of this business.
Does this also encourage a certain amount of hoarding? Like if you're growing coffee and you look out and you see 6 months or a year from now, the price is going to be that much higher, why put it on the market now?
And there is some of that going on right now from the people that we talk to, and we talk to a pretty wide range of influential voices in the coffee sector. Because of this volatility in prices, people are deciding on a daily basis, do I sell today, do I sell a week from now? And this just adds to this perception of scarcity. There is a record amount of coffee being produced around the globe right now. Exports for the first 9 months of the season. Coffee has a season that goes from October to September. First 9 months of that season for the 2011 season, record high exports, almost 16% up. So there is no shortage of coffee. There's plenty being exported. What has gone down are the inventories of coffee. And there are some real supply-demand fundamentals that are in play. They're not the driver, but for the speculation to happen, you have to have this sort of fundamental issue. And we had 3 consecutive bad years of crops in Colombia, which is a premier producer of the high-quality coffee. And they've had low crop yields 3 years in a row, still not back up to what have been the historical levels. And I think that's given some market tightness in the premium type of coffee that comes to the United States, which is different than what gets sold everywhere around the world. And so that's also kind of given a factor. Another factor is the weakening dollar, and the producers of coffee now, much like oil, saying, well, if the dollar's weakening, I need to have a higher payback because in relative terms, my currency is stronger against the dollar. I need to be earning more.
Well, how do you parse out those factors from the speculative factors?
Well, it's the same problem that you have with oil. It's impossible to say it's just this or just that. But everyone from the executive director of the International Coffee Organization on down acknowledges that speculation is putting a premium on it. And just like oil, most Wall Street watchers will acknowledge that this financial speculation has created a premium in the price of oil. The question is, how do you determine how much and what do you do about it? In the case of oil, there are proposals out there to limit the percentage of the market, position limits it's called. No big trader can have more than 10% to influence the market. That's a proposal. On the coffee side of things, you have to kind of look at who's in these markets. It's very hard to distinguish. As we looked at the data, and we took a deep dive into the Commodity Futures Trading Commission historical data, and it's hard to differentiate because of this nebulous terminology who is an actual merchant slash producer who is hedging their coffee purchases or production versus the Wall Street players and the hedge funds, because a lot of the big coffee companies or the big agribusiness companies are both buyers, sellers, and broker-dealers who arrange the transactions. So it's a really murky picture as who's in these markets.
And even the regulations that are being talked about for position limits, and they're talking about a 10% limit to how much any one company can have in a particular commodity. But that seems to be, first of all, a regulation that's being tied up by lobbyists and by the process itself. And it doesn't seem like it will keep out straight speculative casino gamblers anyway. And I guess there's a lot of ways for them to come in and play at different position limits. So right now, if I'm right, there really is no regulation that looks serious either in the short term at any rate.
Well, there are some proposals by some of the bigger critics of the current system who think that we should go back to a cap where strict financial players can have no more than 30% or some percentage of the market.
As a total group, pure bettors can't have more than 30%.
As an aggregate, exactly. The problem with the position limits as being considered is while it's helpful for one big player cornering the market, it misses the point about the lack of people who have skin in the game. In other words, we have paper barrels or paper bags of coffee versus the physical product that's going to be delivered. You get this distortion. And these markets were supposed to be about hedging, risk management. A company is going to hedge against a price shift in the future. These were about what they call price discovery. A buyer and a seller come upon, a fair price. Well, if nobody's ever going to take delivery of these things and there's no real supply and demand signal being given, I think your news organization has done a good job focusing on these so-called high-frequency traders. And these people who come in and out of the market on big algorithmic trades. Well, what does that have to do with price discovery? So I think there's a realization beginning to grow that people are seeing that this isn't a market about things like price discovery and risk management. They're forms of legalized gambling, high-stakes gambling, very technological gambling, and consumers and producers all around the world end up paying the price.
Yeah, I think it's a very important point. I just want to emphasize it, that to say that no particular player can have more than 10% doesn't solve the problem. You need an overall cap on how much of the hedge market can be taken up by pure speculation as opposed to players that are actually going to take delivery and use the goods.
Right, and even that gets to be a difficult definition because, particularly in coffee, where you have people who are playing all three ends of the trade. You have people who are hedging their production, but they also have a finance arm that is involved in the speculative part of it. And they may, if they're big enough, they may act as a broker-dealer. In other words, they bring two parties together and do the transaction on behalf. So you've got all these asymmetrical information flows if these markets really are supposed to be about coming to a fair price. And I think people are starting to, in the academic world, are looking at this, and they're reaching the conclusion that we can't ferret out how much of this is responsible for the pricing. But I think a lot of that debate misses the point, which has been if it's price discovery. It's not how much of this adds to the price. Is this really price discovery, I think, is the fundamental question.
Thanks for joining us, Kevin.
Thanks for having me.
And thank you for joining us on the Real News Network.